Municipal bonds, unique tax feature. Now, as seen in the pie chart in the beginning of this book, municipal bonds are very heavily weighted on the Series 7 exam. Now, the major parts of this section are taxation, types of bonds, the accrued interest calculation, and yields. Taxation. Now, we're going to be going into further detail in the taxation chapter. However, for now, these are the highlights. Interest on municipal bonds. The interest on municipal bonds is federally tax exempt. And if a bond issued by a state is purchased by a resident of that state, it will usually be exempt from state and local taxes as well. And lastly, interest on bonds issued from a U.S. territory, such as Puerto Rico, the U.S. Virgin Islands, America Samoa, and Guam, they're triple tax exempt. There's no federal, no state, or no local taxes. Accrued interest. We've already touched upon this. Accrued interest will be calculated using a 360-day year and 30-day months. This is similar to corporate bonds. Types of bonds. There are many types of municipal bonds. However, the major two types are general obligation bonds and revenue bonds. And we're going to be discussing these two types of bonds in length. Let's begin with general obligation bonds. Now, general obligation bonds are backed by the full faith, credit, and taxing authority of the municipality that's issuing them. And the main points to know for this section are that the issuance of bonds is subject to voter approval. Debt service payments are made mainly by property taxes. Now, this is why the issuance of the bonds are subject to voter approval. So, therefore, you must know the formula to compute property taxes, and it's a very easy formula. You're basically just going to take the assessed value of the property times the mill rate. So, for example, if a property is assessed with a value of $200,000 and the mill rate is given as 6, you're simply going to take 200,000 times 0.006, gives you $1,200 in property tax due. Now note the mill rate of 6. A single-digit mill rate, such as 6, is going to be written as 0.006. A double-digit mill rate, such as 20, is going to be written as 0.02. Now also, the question may be written with a full valuation and an assessed value. For example, the question above may state that the property has a full valuation of $400,000 and an assessed value rate of 50%. So in this case, you're simply going to solve for the assessed value. You're just going to take the $400,000 times 50% to arrive at the $200,000. Then you're going to take the $200,000 times the mill rate of 6, and it's going to give you the $1,200 property tax due. Other taxes used to pay debt service of general obligation bonds. Now, it's important to note that in addition to property taxes, a municipality can use sales taxes, income taxes, and other non-tax revenue, such as licensing fees, parking fees, and recreational fees, to pay the debt service on general obligation bonds. Risk of municipal bonds. Now, municipal bonds are analyzed as to the risk and the factors that are going to be tied to the financial condition of the municipality. So, things that you're going to look for in questions pertaining to the risks of general obligation bonds would be the demographics of the municipality, the employment, the average income, the industry growth, the population growth, things of that nature. Also, it's important to note the official statement is a type of prospectus for municipal bonds. It's called the official statement. Bank qualified muni bonds. Now, in an effort to entice banks to invest in municipal bonds, bank qualified municipal bonds can be issued. Now, a municipality is allowed to issue up to $10 million of bank-qualified municipal bonds, which allows the banks to deduct 80% of the interest costs paid to depositors on the funds which are used to purchase the bonds. Now, the important thing to remember here, there's two numbers, $10 million and 80%.